She did everything right. She saved for over 30 years. She talked to her financial advisor. She converted her traditional IRA to a Roth, exactly like she was told to. And then the letter came. Her Medicare premium had jumped by more than $400 a month. Nobody warned her. Not her advisor, not her accountant, not a single person she trusted. And here's the thing, she's not alone. This happens to thousands of retirees every single year. People who thought they were making a smart decision. People who planned ahead. People just like you. A Roth conversion can be one of the best financial moves you make in retirement. Done right, it can reduce your taxes for the rest of your life. It can protect your money from future tax increases. It can leave more for your family. But done wrong, even with good intentions, it can trigger tax bills you didn't expect, Medicare costs you didn't plan for, and financial consequences that quietly add up over years. And right now, in 2025, this matters more than it ever has. Under current tax law, the lower tax rates many Americans enjoy today are set to expire. Many tax and retirement planning experts have pointed to 2026 as a critical window, a time when planning your Roth conversion carefully could mean the difference between a smart move and a very costly one. So before you convert a single dollar, or if you've already converted and you're not sure you did it right, stay with me. Because the 5 mistakes we're going to talk about today, they're not obvious. They're not things most people think to check. And together, depending on your situation, they can add up to tens of thousands of dollars you didn't have to lose. Let's start with the one that catches the most people off guard. Converting too much in 1 year. Robert was 64. He'd been reading about Roth conversions for 2 years. He understood the basic idea. Move money from your traditional IRA to a Roth. Pay taxes now, enjoy tax-free growth later. So he sat down with his accountant, looked at his balance, and decided, why not convert a large amount this year and get it done? He converted $180,000. What he didn't fully understand was this, that $180,000 got added on top of his other income for the year, his Social Security, his pension, his part-time work. All of a sudden, he wasn't in the 22% tax bracket anymore. He was in the 32% bracket. The tax bill that came was thousands of dollars more than he expected. This is one of the most common Roth conversion mistakes people make, and it's completely avoidable. Here's the simple rule. A Roth conversion isn't an all-or-nothing decision. One of the most effective Roth conversion strategies to reduce taxes is something called bracket management, converting just enough each year to fill up your current tax bracket, but not cross into the next one. For example, if you're in the 22% bracket and you have $30,000 of room before you hit the 24% bracket, you convert $30,000, not $180,000. Small, strategic conversions over several years almost always beat one large conversion. And right now, under current tax law, many Americans are sitting in historically lower tax brackets. If those rates rise, as many financial planners expect could happen around 2026, doing smaller, smarter Roth conversions now could protect a lot of money. But here's the thing, even if you get the tax bracket right, there's another cost most people never check, and it could add hundreds of dollars to your monthly expenses. Ignoring the Medicare trap. Remember the woman from the beginning of this video? The one who got that letter? What happened to her has a name. It's called IRMAA. IRMAA stands for Income-Related Monthly Adjustment Amount. Simple version. If your income goes above a certain threshold in a given year, Medicare charges you more for your premiums, significantly more. And here's the trap with Roth conversions. When you convert money from a traditional IRA to a Roth, the IRS counts that converted amount as income for that year. So let's say your normal income is $60,000. You're comfortable. Your Medicare premiums are manageable. Now you convert $80,000. Your income for that year looks like $140,000. And Medicare looks back 2 years when they calculate your premiums. So 2 years later, when you might not even remember the conversion, your Medicare bill goes up. Sometimes by $200 a month, sometimes more. For a couple, that can double. That's Roth Conversion IRMAA. and it surprises people every single year. The good news? It's plannable. Working with a tax professional before you convert, checking exactly where your income will land against the IRMAA thresholds can help you avoid this entirely, or at least reduce it significantly. This is one of those mistakes where the cost doesn't show up right away. It shows up quietly, 2 years later, in your mailbox. And the next mistake we're going to talk about is similar. It hides, it waits, and when it finds you, it's often too late to undo it. The hidden tax rule most people miss. This next mistake is one that many people, including some financial advisors, overlook. It's called the pro rata rule. Here's what it means in plain English. If you have multiple IRAs, some with pre-tax money, some with after-tax money, the IRS doesn't let you just convert the after-tax portion and call it tax-free. They look at all your IRA money together and calculate a proportion. Let me give you a simple example. Let's say you have $90,000 in a traditional IRA and $10,000 in a non-deductible IRA, money you already paid taxes on. You might think, I'll just convert the $10,000 I already paid taxes on. That should be tax-free, right? Not quite. Under the Roth Conversion Pro Rata rule, the IRS sees your total IRA balance as $100,000. Of that, only 10% was after-tax money. So only 10% of whatever you convert is considered tax-free. The other 90% is taxable, no matter which account you pull from. This surprises people deeply, especially those who have been making non-deductible IRA contributions for years, thinking they were building up tax-free money to convert later. The pro rata rule means that strategy can backfire badly. Now, there are ways to work around this. Some people roll pre-tax IRA money into a 401k first, then convert what's left. But this takes planning, it takes time, and it takes knowing the rule exists in the first place. Most people find out about this rule after they've already converted, and by then, the tax bill is already on its way. Have you ever made a financial decision that felt right at the time, only to find out later there was a rule you didn't know about? That's exactly what this feels like. And the next mistake is about something just as important. Not what you convert, but when. Converting at the wrong time. Gary retired at 62. The year he retired, his income dropped significantly. He had no salary anymore. His Social Security hadn't started yet. His pension hadn't kicked in. For about 2 years, his taxable income was the lowest it had been in decades. He didn't convert a single dollar. Then at 65, he started Social Security. His pension started. His income went back up. That's when he decided to do his Roth conversion. He paid taxes at a higher rate because he waited. He missed a 2-year window where his tax bracket was at its lowest point. Knowing when not to do a Roth conversion is just as important as knowing how to do one. But the flip side is equally true. Some people convert during a year when they sell a business, receive an inheritance, or get a large distribution. Their income is already high. Adding a conversion on top of that can push them into a much higher bracket, unnecessarily. The best time to convert is usually in a gap year, a year when your income is lower than usual. For many retirees, that gap sits right between when you stop working and when you start taking Social Security, or RMDs, required minimum distributions. That window can be small. It might be 2 years. It might be 5. But for the people who use it wisely, it can make a meaningful difference over time. The question worth asking yourself is, when is my income going to be the lowest it will be for the rest of my life? That's probably your best Roth conversion window. And the last mistake? It's the one most people don't expect to hear. Thinking a Roth conversion is always the right move. This one might be the hardest to hear, because everything you've read, everything you've been told probably sounds like Roth conversions are smart. Do them. The sooner, the better. And for many people, that's absolutely true, but not for everyone. There are real situations where a Roth conversion simply doesn't make financial sense, and understanding when not to do a Roth conversion is just as valuable as knowing how. Here are a few examples. If you're in a high tax bracket right now, and you expect your income to drop significantly in retirement, paying taxes on the conversion today could cost you more than just leaving the money in the traditional IRA and paying taxes later at a lower rate. If you don't have outside cash to pay the taxes on the conversion, and you'd have to use money from the IRA itself, you're reducing the amount that actually makes it to the Roth, and that shrinks the long-term benefit considerably. If you're in your mid to late 70s or 80s, the math on long-term tax-free growth starts working against you simply because of time. The break-even point on a Roth conversion requires years of growth to pay off. And if your heirs, the people who will inherit your IRA, are likely to be in a lower tax bracket than you are right now, it may actually be better to leave the money as a traditional IRA and let them inherit it under their own, potentially lower tax rate. None of this means you shouldn't consider a Roth conversion. One of the most overlooked Roth conversion strategies to reduce taxes is simply getting a second opinion from a tax professional who looks at your full picture: your age, your income, your beneficiaries, your state taxes, all of it. Because the right answer isn't always yes, and it isn't always no. It's for you, right now, given everything. What actually makes sense? Here's what I want you to know before we wrap up. The people who make these mistakes are not careless. They're not reckless with money. They're the people who saved for decades, who worried about retirement for years before it came, who wanted to do right by their families. They made these mistakes because nobody sat them down and explained it clearly, because the rules are genuinely complicated, because the consequences are delayed. They don't show up until months or years later, when it's hard to trace back. If you've already made one of these mistakes, it's okay. Many of them can be addressed, reduced, or worked around with the right guidance. And if you haven't made them yet, that's exactly why you're still watching. That's not luck. That's you taking your retirement seriously. The people who sleep well in retirement aren't the ones who had the most money. They're the ones who understood their plan, who knew what was coming, who weren't caught off guard. That peace of mind is worth more than any single financial decision. A Roth conversion is not something you should rush. It's not something to do because you heard it was a good idea, or because someone at church mentioned it, or because a headline made it sound urgent. It's something to do thoughtfully, strategically, at the right time, in the right amount, with a clear picture of your income, your Medicare, your tax bracket, and your long-term goals. Under current tax law, many planners believe the window between now and 2026 represents a real opportunity for people who qualify. But opportunity doesn't mean do it immediately. It means now is the time to look carefully, to get the right guidance, to ask the right questions. The 5 mistakes we talked about today are all avoidable. Not every financial mistake is, but these ones are. You don't have to be an expert. You just have to know these traps exist, and then work with someone who can help you navigate around them. That's not complicated. That's just planning. And you're already doing it. Before you go, I want to ask you something. Have you ever made a financial decision that felt completely right at the time, only to find out later there was something you didn't know? Drop it in the comments. You might be surprised how many people feel exactly the same way. And honestly, those conversations in the comments are some of the most valuable ones we have here. If this video spoke to you, make sure you don't miss the next one. We're going to talk about the retirement tax mistakes that quietly follow people into their 70s, the ones that are even harder to see coming than the ones we covered today. It's worth your time. Take care of yourself.